Cheap and penny stocks aren't usually two words that go together. You want that supernormal growth, 30–40% sales growth and higher in a penny stock that takes earnings skywards and your portfolio along with it. But that kind of 10x growth comes at a price. Those common valuation measures like price to earnings and price to sales are multiples higher than other stocks, meaning you pay through the nose for penny stock growth. But there are cheap penny stocks out there if you know how to find them, that perfect combination of high growth and at a great price. I'll show you how to find penny stocks too cheap to ignore, and then reveal 5 penny stocks to buy right now. Let's get started with our list of penny stocks with the Real Brokerage Inc., ticker REAX, an $827 million real estate platform for agents that could do really well with the changes we're seeing with the agent model. The platform streamlines the experience for buyers with a mobile solution and creates more revenue opportunities for agents, something that could be more important if agents aren't able to charge a fixed commission anymore. Sales are expected higher by 47% this year and 27% next, the kind of fast growth we want to see with these penny stocks. And while earnings are still negative, company is moving closer to net profits. Real Brokerage is already up to nearly $800 million in sales and over 16,000 agents using the platform in just 2 years. There's no long-term debt and free cash flow is positive with the shares trading at a great valuation. Back to our list with Bakkt Holdings, ticker BKKT, quite a bit smaller at $118 million market cap. Bakkt is a cryptocurrency custody and trading platform planning to launch its own Forex-style network. The company is targeting larger institutional traders new to cryptocurrency trading, but with that need for low latency and low cost. This is still a very new platform with just 6 million accounts, but strong growth in its trading volume and AUM, passing $1.2 billion in assets under custody last quarter. That's helped it grow revenue by 322% just since the previous quarter to $854 million, with guidance for up to $5 billion for the full year and an increase of 3x in trading accounts. Management does expect to use around $60 million of its balance sheet cash for operations, but will have enough to grow into next year. Now, this one is still deep in the red for profitability, but has $76 million in cash against just $26 million in debt, so a net cash balance sheet, strong growth, and time to grow. With an enterprise value of $69 million, that EV to revenue valuation is extremely low, a cheap penny stock that should be on your radar. We've still got the 3 cheapest penny stocks left to highlight, but Nation, you know I'm not about to just drop a list of stocks in your lap and say, hey, go buy these. That keeps you dependent on all the yahoos here on YouTube for picking your stocks and does nothing for you. I want you to be a better investor, so I want to show you how to find these penny stocks to buy for yourself. You can use any stock screener to start your search. I'll use the one here on Yahoo Finance because it's free and available to everyone. And remember, this is only a start, a way to narrow down that list of 10,000 plus stocks to find those penny stocks worth your time to research before you narrow down to 5 or 10 for your long-term portfolio. To filter the stocks down, I'll be using the market cap of the company, or that total value of the shares available. Then the price to earnings to growth ratio, or the PEG ratio, and the enterprise value to revenue ratio for our valuation measures. That's a way of finding those cheap penny stocks. And then that 1-year change in revenue to find those growing sales fast, the kind of penny stocks that can someday 10x your money. Now, I'll explain each of these criteria and why I'm using them, but starting off with that market capitalization of the stocks under $1 billion, this is that real definition of a penny stock. And folks, every time I do a penny stock video, I see comments about how not all the stocks are trading for under $1 per share or something about that price. Understand, share price means nothing here. A great example here is you wouldn't consider $89 billion Rolls-Royce a penny stock company. Even with shares under a penny each, the 120-year-old company just isn't that kind of fast-growing startup company that we're talking about. On the other hand, $25 per share Alico may not seem like a penny stock, but the total value of the shares, its market cap is just $196 million, making it one of the smallest companies I'll highlight. A company expected to grow revenue by an average 50% this year and next. So just don't get caught up thinking that penny stocks have anything to do with the share price. It's that size of the company that we're talking about, and more than that, those micro-cap stocks growing revenue by high double digits with the potential to 10x your money. And you're just more likely to find these in those small pre-unicorn status companies under $1 billion market cap. Next here, we'll filter for a price to earnings to growth ratio under 1.0, and this is going to be our key ratio for finding cheap stocks. You're probably familiar with the price to earnings ratio, that PE ratio for stock valuations. That's the price of the stock. So for example, Nvidia shares here for $124 each and divided by the earnings per share the company has reported over the past 4 quarters. For Nvidia, that's $1.80 in per share profits reported over the past year. So the price, $124 divided by per share earnings, is the price of 69 times earnings, that PE ratio. Now you do see it shows 73 times PE ratio here, and that's probably due to rounding and how it's calculating those earnings. And compared to something like a Coca-Cola with share price valued at 25 times earnings, Nvidia seems ridiculously expensive. Why would an investor pay to buy NVDA, paying a price of 70 times the profits generated when they could pay just 25 times PE for KO? And of course, the obvious reason is growth. Nvidia is expected to double its net income this year to $2.71 per share, and then to post 34% earnings growth to $3.63 per share next year. Compare that to the 12% earnings growth this year and just 7% next for Coca-Cola, and it's clear that Nvidia has that kind of supernormal growth that is going to reward investors. And it's going to be something you see across all fast-growing stocks. These stocks' growing sales and earnings are going to be trading at higher valuations because of that growth, but it doesn't mean they aren't still great deals. That's why you want to adjust for growth with that price to earnings to growth ratio. Here we take the PE ratio, so that basic measure of valuation, and then divide it by the growth rate in the company's earnings. So for example, adjusting that 69 times PE ratio on Nvidia by its long-term earnings growth of 49%, and we get a PEG ratio of 1.4 times. Do the same for Coca-Cola, dividing its 25x PE ratio by a long-term average of 8% earnings growth a year, and we get a price to earnings rate to growth ratio of 2.9 times. So ironically here, we see that adjusting for that amazing growth, Nvidia shares are actually cheaper on a relative basis versus Coca-Cola. Shares of Coke may be cheap, but the earnings just aren't going anywhere. Well, even though Nvidia trades at 70 times PE ratio, because it's growing so fast, it's the better bargain. Another great way to find stocks not just cheap, but cheap with good fundamentals is this enterprise value to sales measure, and ideally, you want stocks under 1 for this as well. This was a favorite valuation measure of mine working as a venture capital analyst. Whereas that PEG ratio adjusts for growth, the enterprise value measure adjusts for debt and balance sheet health. Enterprise value is the market cap of the company, so the value of all shares in the market, then minus balance sheet cash, but adding back debt that the company owes. It's a great way to see what investors are really paying for a company, and a must-use measure whenever a company has a high amount of debt, or when balance sheet health is key, as with these smaller penny stocks. Using Boeing as an example, the total value of the shares or market cap is $111.7 billion, and we see the company holds $7.5 billion in cash against $47.9 billion in debt. So that $111 billion market cap minus the $7.5 billion cash and adding back $47.9 billion in debt gives us an enterprise value of $152 billion. And now divided by the revenue of $76.4 billion booked over the past year, we get an enterprise to revenue valuation of 1.99 times. Now, that might not mean much by itself, but when we do start to compare it against the valuation for other stocks in Boeing's industry or against Boeing's own historical valuation, we get a sense that the stock is cheap or expensive right now. And while you could just use one of these valuation measures, the PEG ratio or the enterprise to sales measure, I like using both of these to narrow my list and to get a better confirmation of which stocks are truly cheap. And finally here for the screener, to find those fast-growing stocks with the potential to take your portfolio higher, we want to look at the revenue growth. How fast is the company breaking into their market and they're growing their sales? For this, you can play around with the criteria. I started with 30% growth, but that still left 138 companies, so I notched it up a little bit to 40%, which filled out about 20 more, and left me with about 120 stocks to start my research. Because remember, you're not trying to filter down to 5 or 10 companies just yet. Stock screeners are a great start when you're looking at thousands of stocks in the market, but you never want to invest just on what a screener tells you. The goal here is to get that screener to suggest a small enough group to start with that qualitative, fundamental research that we talk about here on the channel. Then you dig into those companies' presentations, competitive advantages, and other fundamentals to really find those very few penny stocks that you're going to want to hold for years. And yes, I know it's a lot of work, and I know you want me to just get back to that list of stocks to buy, but Nation, this is the kind of work that makes you a better investor. Understanding and then going through this research on the stocks to buy not only puts you in control of your money, but will also mean higher returns for your portfolio. Here, the smallest penny stock on our list, and probably the riskiest, is $62 million Beam Global, ticker BEEM, a quick deploy EV charging solution powered by solar energy that can be set up in less than a day versus grid-connected charging stations. And while the slowdown in EV sales has hit charging stocks, Beam still booked 250% sales growth last year and is expected to book 18 to 40% growth this year and next. Earnings are still negative, but the per-share loss of $1.30 last year is expected to narrow to just 25 cents a share through next year. The company is targeting not just electric vehicle charging, but is hoping it can take share in the demand for that off-grid charging of public lighting, commercial building lighting, and telecom infrastructure. Now here, what worries me is cash flow. With just under $5 million in balance sheet cash and burning through $16 million cash flow a year, Beam will definitely need to issue more debt and more shares, but that kind of sales growth should get the funding it needs. It's higher risk, but also higher return. A penny stock under $1 here, $122 million Origin Materials, ticker ORGN, positioning to be the leader in carbon-negative materials, recycling packaging and other materials to convert the carbon into caps and other products. Origin estimates an addressable market of $65 billion in this PET caps and closures business. The company has a strong balance sheet with $146 million in cash, more than the entire market cap of the company, and only $26 million in long-term debt. Now, it is burning through about $50 million in cash a year as it builds to that profitability, but with expectations for 114% revenue growth next year, it should slow that cash burn and grow. I'm going to highlight the cheapest penny stock in the market next, but cheap doesn't always mean the best. Some of the fastest growing and best penny stocks to buy aren't the cheapest but can still 10x your money. Check out this video next for the penny stocks to watch that beat another one of my favorite criteria as a venture capital analyst. Penny stocks that beat the Rule of 40. One of the larger companies here, but still a penny stock at $772 million market cap. Infusion Inc., ticker ENFN, a cloud-delivered software-as-a-service provider for investment managers with services from back-office accounting and operations to reporting and data analytics. Now, this isn't runaway growth here, but consistent 18% a year, and the company is already profitable, expected to book 24 cents per share earnings this year. Now, it's not quite as cheap as some of the other penny stocks on the list at 1.9 times PE to growth, but more stable and still with that penny stock growth we're looking for. Share sale closes tomorrow, July 11th, so do not wait. Don't forget to tap that subscribe button and click the bell notification so you don't miss a single episode.